Well, hello, everybody, and thank you for joining me today for this webinar. We're going to be talking about the CARES Act of 2020. This is the Coronavirus Aid, Relief, and Economic Security Act. So somebody in our government gets paid to come up with these great acronyms. And the joke always is that that's the opposite of what they're doing. So do they care? I don't know. We'll see. But let's go ahead and jump in. Hopefully everybody can hear me. And everybody can see my screen. There are a chat function, so if you have any questions, you can pop it in there. If anybody cannot hear me, let me know that way. Okay, so let's go ahead and jump in. Now, actually, before we jump in, I just have to read a quick disclaimer. Because I'm a member of EdSlot's Elite IRA Advisor Group, they want me to read this. Okay, sounds like you guys can hear me. Perfect, thank you. Okay, so I am a member of EdSlot's Elite IRA Advisor Group, which is a private IRA study group of professional financial advisors. I am not employed by or an independent contractor of EdSlot & Company. EdSlot & Company does not sell, endorse, nor promote any opinions in this seminar, nor any products or services that I am selling. EdSlot Elite IRA Advisor Group is designed to provide its members ongoing access to the most up-to-date IRA information available in order to properly and professionally service their IRA clients. However, EdSlot & Company is not responsible for any financial advice or services that I provide to my clients, and EdSlot & Company cannot guarantee that I have taken advantage of all the resources and tools provided to the members of EdSlot's Elite IRA Advisor Group. Okay, so now that that is done, let's go ahead and jump in. So, CARES Act of 2020. So what are we going to be talking about? There's really going to be 4 points that we're going to be talking about. And this is really designed to just give a broad overview of how this act impacts retirement accounts. So there's other aspects of this, like the paycheck loans for businesses and whatnot. We're not going to be talking about that today. We're going to be talking about how this impacts retirement accounts. So we're going to go over those main points, but we're not going to go too far into the weeds because, I mean, number one, I want you to stay awake. This is IRA and tax law, of course, so it's not exactly the most exciting topic. And two, everybody's situation is a bit different. And so that kind of leads to my third point, which is you always want to make sure you're consulting with an educated, qualified advisor that can help you in your specific circumstances. So as I mentioned, there is a chat function here. I don't know how I'll be able to use it during the presentation, but I'll certainly come back to it at the end and see if I can answer any questions. Again, because of point 2, everybody's situation is a little bit different. So those who are participating, some are clients, some are not. And so I can't get too specific into the answers. I may only be able to answer a few questions. So we'll see how it goes. So if you need more specific answers to some of these things, feel free to reach out. So, all right. So what are those 4 things that we're going to talk about? The four main items that impact us here are the extension for the IRA contribution deadline for 2019. There's the waiver of the 10% early distribution penalty and the special tax relief on that. The plan loans from employer plans have been increased. And then there was the waiver of required minimum distributions for 2020 or RMDs. So these are the 4 main points that we're going to be talking about. We're going to spend most of our time on the waiver of the RMDs. The other things will go pretty quickly. Okay, so the 2019 IRA or Roth IRA contribution deadline. This was extended by nature of the time to file the tax return was extended to July 15th. So along with that is the ability to make that contribution. So if you haven't already done so, you certainly have more time to do that. Now, one of the things, there's a couple things you want to look out for here. So if you do this, you want to make sure your custodian understands that it's for 2019. Sometimes what a lot of people do is the monthly contributions, like automatic contributions. And in all cases that I've seen, those are by default coded as a current year contribution. So if you just made a contribution from an automatic for, say, May 1st, it's automatically going to be coded for 2020. So if you didn't max out for 2019 and you still want to do that, you probably are going to have to make a one-time, manual type of contribution, and make sure that the custodian knows that you want it for 2019. So that's important to understand. Now, remember a couple of points on age for contributions. If you still have earned income, and of course you have to have earned income in order to make an IRA, a Roth IRA contribution. If you have that earned income and you're over 70 and a half or 72, which is the new age for making required distributions, you can still make an IRA contribution or a Roth contribution if applicable, if your income meets the requirements. And so you also have to watch out if you're over the required minimum distribution age. Because of the Secure Act, you can now also make a deductible IRA contribution. We're not going to get into the Secure Act much here, but that was one of the points on that law that was passed in December. That'll be another webinar, so we won't talk about it here. But the little point here is that it extended the age for RMDs to 72. Okay, so even for those people, they can now make deductible IRA contributions. There's other pitfalls and things to be aware of there if that applies to you, so watch out for that. So the extension to make these contributions, it also happens to apply to HSA, health savings accounts, the Archer medical savings accounts, and the Coverdell education savings account contributions as well. Okay. Coronavirus-related distributions, or CRDs for short. Well, what is this? Basically, what's happened here is if you take money out of a retirement account before 59 and a half, in most cases, you're assessed a 10% early distribution penalty. Okay, there are some exceptions to this 10% penalty, which we won't get into here, except for this one. So this is a new exception that they've done specifically because of coronavirus. And so basically that 10% penalty is waived. And this is covering the distributions from IRAs and employer plans, and it's up to $100,000 as long as it's for the COVID-19 related purposes on or after January 1st of 2020. Couple of points here to be aware of. This $100,000 amount is aggregated from all IRAs and plans. So you can't take $100,000 from an IRA and then $100,000 from 401k. It's aggregated. Now it is per person, right? So a married couple could each one of them could do this. That certainly is okay. So it's important to note that the 10% penalty, this is only applicable if you're under 59 and a half, because if you're over 59 and a half, well, you don't get that 10% penalty anyways. Okay. Now, if you're over 59 and a half, you can still do a coronavirus related distribution. Just note that the 10% penalty is not applicable anyways. So what is applicable is the taxes. So when there's these early distribution penalty exceptions or events like this where they let you take money out, this is just the penalty being avoided. You still have to pay taxes on the distribution if it's a taxable distribution, right? So if it's from a pre-tax retirement account, you still have to pay taxes on the applicable portion that is pre-tax, right? That hasn't changed. One provision they put in here, though, to kind of ease the tax burden is the option to spread it out evenly over 3 years. Now, you'll see here my note says that taxes are still due with the option to spread the tax on the CRDs evenly. So it's actually more specifically than that. You're spreading the inclusion of the income ratably over that 3-year period. So it's not the tax you're spreading out per se. It's still calculated in each tax year. So you're basically taking a third of the income and including it on each tax return. So the tax that you pay, of course, will be dependent upon what your other income is for the year. So if you happen to have a high income year next year, you might end up paying more tax because of the spreading of the income from this special distribution over that 3-year period. Now, this is an option. So if you do take a coronavirus related distribution, you can pay the tax all in 1 year. That's your option. So it's a choice. So they also give a 3-year period to repay it. So A couple points here. Now, if you take the money out of, say, an employer plan, it does not have to go back to that same employer plan. So it can get repaid to a different plan. I'm kind of wondering, there might be some things that come out of this where people are trying to get money out of their employer plans and put it into IRAs instead. I don't know if that's going to work or not. That'll be something we'll probably have to wait to see some more guidance from IRS on. But basically, you get to, you have a 3-year period to repay it. And when you do so, you're going to file an amended return for that year. So you take the distribution, say this year, you include it for this year, but now next year, you repay part or all of it. So you're going to go back and file an amended return for 2020 and fix it that way. Again, so it does not need to be repaid to the same IRA. Okay. Who qualifies for this? So can anybody just take this distribution? Well, no. So you have to be directly affected in some way. So you have to be, if you yourself were diagnosed with the virus, you're going to qualify. If you have a spouse or dependent who's diagnosed, you're going to qualify. Or if you experience, quote, adverse financial consequences, consequences, end quote. You can't see me, but I'm doing the air quotes here because there's some things here where it's going to be kind of hard to tell what really applies. But this is the list we have so far. So if you are experiencing adverse financial consequences because you've been quarantined, you're being furloughed or laid off or having work hours reduced due to the virus, you're being unable to work due to the lack of childcare because of what's going on, closing or reducing of hours of the business owned or operated by the individual due to the virus, or, again, some air quotes, other factors which are to be determined by the Secretary of the Treasury. In other words, they might come out with some things later on that might kind of ease these restrictions and whatnot. So this seems to be somewhat new territory. There have been other disasters of different types that usually are regional, like when there are the California fires or the floods from the hurricanes. Sometimes there's regional things that happen that allow people to have certain rules that they are relaxed for them. So this is kind of national scale. So there's some unknown here. So we wait to see what else that they might come out with. So they could be relaxed. So these are all distributions that are, you're taking the money out of the plan, you're realizing the income, pay the tax, and so on. The other option, if you're a participant in an employer plan, is to take a loan from the plan. So, of course, when you take a loan, it's not a taxable distribution. You're just simply borrowing essentially from yourself, and then you repay yourself, basically interest. Now, it's noted that some people say, well, that's a great idea because you're paying yourself back with interest. But the way that the money is accounted for in the plan, it's no longer invested either. So that could be a good thing, could be a bad thing. You don't know. It depends on what happens there with the markets. So what they're doing here is they've risen the maximum loan amount to the lesser of $100,000 or 100% of the vested balance. Now, this is going to be reduced by any other outstanding loans. So if you already had a loan outstanding of, say, $40,000, you're not going to be able to take another $100,000. They're going to factor that in. This is going to be applicable to loans taken by September 23rd of the year, at least as it's written right now. And just noting that normally a plan loan is the lesser of $50,000 or 50% of the vested account balance. So they've kind of sort of doubled that basically. Now you're going to want to make sure, check the plan, because not all plans allow this. Right? This is an IRS rule, but it's plan specific, so the plan has to allow it. So if your plan doesn't allow it, then this would not be an option. So repayments on these loans that normally would have been due between March 27th of this year and the end of this year, 12/31, may also be suspended for 1 year. Now, this is an important point because normally a default on the payment can cause what's called a deemed distribution. This is also related to termination of employment, so I'll talk about that in a second here. But basically, if you default on the plan loan, then they can say, oh, well, this is a distribution, it's now taxable. And so, of course, if you're under 59.5, you would normally be assessed with that 10% penalty. So there's definitely some pitfalls in taking plan loans. So this little point here is alleviating some of that issue. because they're allowing the payments to be suspended. So this allows you to take the loan from the plan and suspend the payments for a period of time. So again, termination of employment could cause a deemed distribution. This is as it is normally. I believe it's still going to be applicable. Again, it depends on the plan rules. I think a lot of plans don't want to be administrators of loan repayments of former employers. So it's really, really important if you're going to take a plan loan to check the plan document, check with the plan provider to find out what the rules are. Because what you don't want to do is take a distribution of $100,000, figuring you're going to have plenty of time to pay it back. And then if you're terminated, laid off, or you quit, or whatever the case may be, does that termination of employment cause that deemed distribution or not? If it did, that would certainly probably cause a problem. Now, does this tie into the coronavirus related distributions? I don't know. That would be something interesting to see if someone did get a deemed distribution because of termination of employment. Do they then fall under those CRD rule limitations or the relaxation of that rather? Again, I don't know, but hopefully these will be answers that will come out with time. So also notable that loans are not available from IRAs. So while you can take money out of an IRA anytime you want, you normally have 60 days to put it back. But you got to be really, really careful about that 60-day time period because you got to get it. If you don't get it back in, you could have some problems. So we'll leave it at that for now. Okay, so the big one that we're going to spend most of our time on here again is the 2020 RMD waivers. So this is only applicable for 2020. Basically, when you reach it used to be 70.5, again, it's now 72. You are required to start taking distributions from your retirement accounts. And so what they've done is they've basically just waived it for 2020. They did this because there's an assumption that the account values are down. And so you're having to take this distribution based upon a value that used to be higher. When you calculate your RMD, you're using the 12/31 prior year-end balance, right? And so the assumption is the account is much lower now, and now you have to take this big distribution when the account is lower in value. So they're trying to ease up on those rules a little bit. They did this in the financial crisis. Same kind of thing. They waived RMDs in 2009. So we have seen this happen before. So it's applicable to IRAs, both traditional and Roth inherited IRAs, right? On Roth IRAs, there's not normally required distributions for the account owner during lifetime, but an inherited Roth IRA does have required distributions. And so these are waived for those as well. Also applicable to company plans such as SEP Simple IRAs, 401k, 403b, and 457b plans. Now, this whole notion of the RMD waivers, it's kind of interesting because if somebody has received, if they need to take the money because they've been impacted, does the fact that they are not forced to take a distribution make any difference? I don't know. This rule, it's interesting because I think it's actually benefiting the people who don't need to take the money. So if you don't need it, then you get to leave it in there and let your account balance recover faster. Right. So it's just one of those interesting quirks about doing this. But nonetheless, it's done and certainly can help a lot of people. So it's important to know the ins and outs of that. So for the rest of this, we're going to go through in kind of a Q&A format because a lot of questions come in on this topic. So I'll try to address most of those. Okay, here we go. Okay. All right. So one of the questions comes up is, what about the 2019 RMDs? Now, okay, so the question is, I turned 70.5 last year, 2019, and my first RMD was for 2019, but my required beginning date was April 1st, 2020. Is my RMD affected? So just a quick background there. Normally, when you hit the year in which you're required to start taking your first RMD, your first distribution, only in that first year, you can actually defer it until April 1st of the following year. It's only for the first one. And so when that happens, normally what you do is you defer it to the next year. But in that next year, you have to take two. you have to take the one you deferred plus the one for that year. So you kind of have to double up, right? So that would be under the normal rules. Also, again, I want to note here that the age for the RMDs has increased from 70 and a half to 72. That was from the Secure Act, which again, I'll be doing in another webinar a little bit later. So let's see. So sometimes that would be worthwhile doing. Certainly if you expected your income to be lower in the next year. Let's see. Looks like we had a question. Yes. So the RMD waivers are applicable to traditional and Roth inherited IRAs. So inherited IRAs, inherited accounts, really, I should say, because if you had an inherited 401k, it would be the same thing. So. Okay, so the answer to the question, can you defer that RMD, that 2019? The answer is yes. So if you delayed your first RMD that was supposed to have been taken in 2019, but you deferred it until January 1st, 2020 later, whatever portion remaining on that 2019 RMD, it is waived, as is your entire 2020 RMD. Okay, so this is really kind of interesting. So if you happen to have been required to take your first distribution last year and you deferred it to 2020, that's kind of working out double for you, because not only do you still not have to take that one, you also don't have to take your 2020 as well. Okay, so that's kind of a good deal. What about partial RMDs? The question, I took some of my RMD for 2020 based on the 2019 IRA balance, but not all of it. Can I delay the rest until 2021 now that the market has dropped? The answer, of course, is yes. If you already took a portion of your 2020 RMD, you can stop taking distributions for the rest of 2020. So there really is no requirement to take the rest because it was all waived. So in 2021, you're going to have a new RMD calculated on your 12/31/20 balance. All right, what about future RMDs? Is my 2021 RMD also waived? At this point, the answer is no. So the CARES Act only is applicable to the 2020 RMDs and those 2019 RMDs that got delayed to 2020. 2021 RMDs are unaffected, at least at this point. Could they be included later? It's possible. I mean, I guess it depends on what happens with the markets. If they went down again or stayed down, anything is possible. But at this point, that has not been addressed at all. Okay, suspended RMD. The question is, I heard that RMDs were just suspended and that the waiver is temporary. Does that mean I need to double up next year and take both my 2020 and 2021 RMD? Well, the answer is no, simply that the 2020 RMDs, they're waived, so you don't have to take them. This question, I believe, comes from the expectation, as I described earlier. In that first year, you're supposed to take RMDs when you can defer it to the next year, and then you have to double up. This probably comes from that, but no, it's waived. It's not suspended. It's waived. You don't have to take it. Okay, what about rollovers? So normally an RMD, required minimum distribution, is not a rollover eligible distribution. It cannot be used for Roth conversions. Once they come out, they have to stay out. So the question has come up, can I roll over or replace my RMD if I already took it? The answer is yes. So if the distribution qualifies under the normal rollover rule. So basically what's happening here is that, again, normally you cannot roll over an RMD, right? But in this case, if you already took a distribution, they're retroactively saying there is no RMD this year. So that distribution is just a regular distribution if you already took it. So a couple things here. So the normal rollover rules, there's the 60-day rule that applies. So what started to happen is that any distributions that happened, any RMDs that had happened in January were not rollover eligible. So they were saying those that happened after February 1st. The IRS has provided some guidance on this since I typed out this presentation. Of course, I have to get it approved, so I can't really change things on the fly. But they did provide some guidance on this where they kind of further relaxed these restrictions. So basically, RMDs that were taken between February 1st and May 15th have until July 15th to roll over that RMD payment. Okay, so RMDs in January and after May 15th, the normal 60-day rule still applies. So if you happen to have taken your RMD in January, unfortunately, you cannot roll that one over. And then as we get to May 15th, anything that happens after that, I guess they figure you know the rules already and you know that you don't have to take an RMD. So they did relax that a little bit. You know, could we see some further guidance on this? It's possible. So you got to watch out for a couple of things here. Certainly the once per year rule also applies. This is where you can only, you can take as many distributions from an IRA as you want, but you can only roll over one of them within a 365-day period. So it's really, really critical to understand that this once per year rule is not a calendar year rule. It's a 365-day rule. So you can't take, if you had a distribution December 31st and then another one January 1st, you can't roll over both. You only have 300 per 365 days. Okay. So when the, let's see. So that rule applies, let's see. Oh, let's move on. I think I addressed that question that's going to come up here in a second. So what if I already did a 60-day rollover in the last 365 days? So yeah, that's what I was going to say. The last time RMDs were waived in 2009, IRS did not waive the once per year rule. And there's no expectation that this is going to happen again. So, you know, what can you do if you already took a 60-day rollover in the last 365 days? Well, there's at least two possible things. One is you could do a Roth conversion, right? So when you do a Roth conversion, it works because the amount that was taken, right, the distribution from the IRA, it's no longer considered an RMD, right? It normally would not be eligible to be converted to a Roth, but in this case it is, because it's not considered an RMD. It was just a distribution. And so the 60-day rule doesn't really apply here because you're doing a Roth conversion. It also is the same for an employer plan. So if you have an employer plan and the plan will allow, then you can roll it into the plan. So there's a couple of ways of fixing that. Okay, let's see. Okay. There we go. All right. What about inherited IRA rollovers? And let's see. We've got a question here. So regarding the waiver of an RMD on an inherited IRA, if an IRA was inherited this year, 2020, so actually I'm going to address that question right now. So the question is, if I have an inherited IRA and I already took my RMD, can I roll it back or replace it? The answer is no. So non-spouse beneficiaries, owners of inherited IRAs cannot do 60 days rollovers regardless of the type of distribution. So once the money leaves the account, it can never go back. Spousal inherited IRA, there's some different rules. We're not going to get into that here, but if with inherited IRAs, once the distribution comes out, that's it. It's done. It's out. Cannot be fixed. There's no exception here, and there's no relaxation on this rule either. So again, the last time RMDs were waived, there was no relaxation on this rule either, and I would not necessarily expect it to be either. Okay, so year of death RMD. Question: does my 75-year-old father died in January of 2020 without having taken his RMD for the year? I'm establishing an inherited IRA. Do I need to take his year of death RMD? So normally when you're subject to RMDs that require distributions, you have to take them by the end of the year. And sometimes this happens, you know, the IRA owner, they die before they took their own RMD. There could be different reasons for that. But it's important to note here that when a when someone dies and the IRA is inherited, the beneficiaries still have to take that year of death RMD when it's normally applicable. It does not go to the estate. That's a common misconception. But again, in this case here, because of the CARES Act, the RMDs were waived. So there is no year of death RMDs. The 2020 RMD for the account owner, the 75-year-old in this case, it was already waived, so it's not required. So again, same thing is going to be applicable. This is, the beneficiaries would normally take that person's year of death RMD, but there is none. It's waived, and we don't have to worry about it. Let's see. Now, another point that we want to consider here, beneficiary. So there's new rules now. Again, this is more related to Secure Act, which I'll go into in a later date on that webinar. But under the new rules, the stretch IRA is gone. So you can't take the life expectancy distributions anymore, with some exceptions, but it's basically a 10-year rule now. And so the way that it works in brief is that there is no more annual RMD. It just has to come out by the end of the 10th year, right? And so in this case, the beneficiaries are still bound by the 10-year rule. It does not become an 11-year rule. So even though the RMD is waived, they still have to get all the money out within 10 years. Now, the distinguishing point will be when the death occurred. So if the death was in 2019 or prior, it's under the old rules. If the death was 2020 or beyond, it's under the new rules. That's about anything else is kind of beyond the scope of what we're talking about here. But certainly keep an eye out for that topic when we go over that. So as far as the 60-day rule goes, the question is, will the government waive the 60-day rollover requirement and/or the once per year rule? So this question was here before they relaxed the guidance. So, but just to reiterate, the last time RMDs were waived in 2009, IRS did eventually also waive that 60-day rollover requirement, but that guidance didn't happen until later in the year. So we just have to kind of wait and see on that one. And again, we know that they did not waive the once per year rule or allow non-spouse beneficiaries to roll over the funds. So I don't think there's any expectation that that would happen again. You never know. Congress does some funny things sometimes. And what I find interesting about IRA rules is they don't always are aware of the rules that are already in place. So yeah, again, anything is possible here. Okay, tax forms. Are there any special tax forms that I need to file to report my required minimum distribution rollover? Well, the answer is, as of now, no. You're going to receive the same 1099-R that you would have received for a distribution. Anytime money comes out of retirement account, 1099-R is generated. And then when you actually file your return, there's a certain procedure to put on the return that references that it's a rollover, and the money, there's no entry there in the taxable field, or at least as it relates to this one. And then usually around May of the following year, you get a Form 5498. That's just simply going to reflect that the rollover occurred back to a qualified account. You do not need that for your tax return. It's just more of a reporting item. Now, so yeah, for the most part, you're going to reference this on your tax return as you would any other distribution or rollover. So now one thing I want to mention here is the 3-year income spread on the coronavirus related distributions, those CRDs. There might be some special forms on that. I'm actually not sure, but there's going to be a procedure there to report how much income. And so how that actually is done, I'm not sure. There was a procedure done the last time there was, gosh, I don't remember the year. I think it was 2010 when they allowed Roth conversions to spread the income over, it was 2 or 4 years. They've done that a couple of times. I don't remember at this point, but so there might be a form there. So that would be something to be aware of. Okay, first money out rule. Question, since RMDs are waived, can I do a Roth conversion without taking my RMD first? Can I roll my 401k into an IRA without taking the RMD? So again, under the normal rules, you would have to, if you were subject to RMDs, take them first before you do a Roth conversion, right? So in this case, the answer is yes. You can go ahead and do those Roth conversions or a rollover without a concern about taking your 2020 RMD because, again, there is no RMD to take. So it's waived. Don't have to worry about that. Qualified charitable distributions, or QCDs. The question is, can I do a QCD? Well, if you're not familiar, what is a QCD? Basically, the qualified charitable distributions would allow you to take money out of an IRA, and basically you would pay the money directly to the charity. And this is a really, really important point, because normally when you take the money out of the IRA, you can still make a donation to a charity and get an applicable write-off. But what's happening in your tax return is you're increasing your adjusted gross income. You're still realizing the income, and that can set off a lot of bells in the tax return is like a pinball machine. You hit one thing and it changes a bunch of other things. So this can impact other areas such as Medicare surcharges. It can bump your income over one of those thresholds, and you increase your Medicare premiums because of that. So there's other areas where this can be affected. So that what the QCD allows you to do is to give money directly to the charity. It goes directly from the IRA to the charity. This is better than getting the deduction because you never realize the income in the first place. Also, you can use you can use up to $100,000 to satisfy towards a required distribution if you had it. So this is kind of where the question comes from, because in this case, RMDs are waived, right? So can you still do a QCD? Absolutely, right? The QCD can still be done to satisfy an RMD up to the 100,000. But again, one need not have an RMD to do the QCD. So since the RMDs are waived, it doesn't impact this here as far as doing the QCD. Okay. All right. Voluntary withdrawals. Can I still take my 2020 RMD if I want to? Well, sure. You can always take more than the minimum, because in this case, this year, the minimum is 0 because there is no RMD. Right? It's pretty straightforward on that one. Okay, taxes due. Since RMDs are waived for 2020, if I decide to take it anyways, does that mean there is no tax due on that withdrawal? Unfortunately, no. Again, there's been some provisions that are allowing people to get money out. There's a waiver of the RMD. There's the waiver of the 10% penalty if you apply, if you're one of the affected people, but it's still a taxable distribution, and those distributions are going to remain taxable. So it's hard to get away from Uncle Sam on this one. If there's money that hasn't been taxed yet, they're definitely going to want their money, especially now. I mean, no doubt this is kind of beyond the scope of this topic here, but certainly looking at the deficit spending we have been doing and what we're doing now to get us through this coronavirus, taxes are probably going up, and they know it. So I don't see any reason they are going to waive the actual tax on the distribution. So. Okay, so 72T payments, these really aren't applicable to a lot of people, but something to be aware of. Are my 72T withdrawal requirements also waived for 2020? Just really quick, a 72T payment is a special type of payment. It's called a substantially equal periodic payment. It's one of the exceptions to the 10% withdrawal penalty. If you're under 59 and a half taking money out of an IRA. And so you can set these schedules up so that you can get that money out and avoid the penalty. But the rules are really strict, and you have to. There's very little modification that can be made. Otherwise, it can cause a distribution to be taxable and subject to the penalty retroactive to day one of when that schedule started. So the question has come up: are my 72T withdrawal restriction requirements also waived for 2020? And the answer is no. So these 72 payments are not required minimum distributions, right? There's something different. So those schedules have to continue as is for now for 2020. Again, unless IRS or Congress or whoever comes out with some additional guidance, as it is, those would have to remain. Okay, the 5-year rule. So this one's a little kind of one of those interesting ones. So normally when a non-designated beneficiary, meaning like a non-person, typically like an estate, inherits an IRA before the owner's required beginning date, normally they have a 5-year payout, meaning, again, this is under the old rules primarily where there was the stretch IRA. But in this case, if someone died before their required beginning date and they didn't have a designated beneficiary, then this 5-year rule applied where all the money had to come out within 5 years. So it's kind of similar to how RMDs are now for inherited accounts, in that it's just 10 years and has to come out by the end of the 10th year. Kind of similar, but this was the 5-year rule. So it's still in effect, but the question is the 5-year rule payout affected? So it's interesting here. So for those non-designated, again, non-person beneficiaries who inherited from 2015 to 2020, the 5-year rule now becomes a 6-year rule. So if you recall, I mentioned earlier about the 10-year period going forward for inherited IRAs. The RMD waiver does not make it an 11-year, but here in this case, because this 5-year rule, it does make it a 6-year rule for these people. So that's kind of an interesting one, probably unintended, one of those quirky, lesser-known rules that those who wrote the CARES Act probably didn't even realize it was there. So who knows? We can only speculate on these things. So. All right, what about life expectancy? So the question is, which life expectancy age do I use next year in 2021 when those RMDs start back up again? And what about for those inherited IRAs? So the answer is that most IRA owners, they're going to use the age they reach in the applicable year. So in 2021, they're going to go to the Uniform Life table to look for their corresponding life expectancy factor for the age at which they attain in that year. So there's no change on this for those, for most IRA owners. They're still going to go to that table, look up their life expectancy. The only thing that could be here is that if the IRS adopts a new life expectancy tables, which I believe is in process, but that's kind of a separate rule. You still go back to the applicable table each year as an IRA owner for calculating your RMD. So spousal beneficiaries are going to do the same, except that they go back to the single life table each year, but it's still what's called a recalculation, meaning they go back to the table and they find their life expectancy for the applicable year, right? Now, the non-spouse beneficiaries, normally they do not recalculate their RMD. They just go to the single life table for the age in which they attain in the year after death. And then in the future years, they just simply subtract one each year. So they do not recalculate. They do not go back to the table. So in this case, even though the RMD is waived, they don't have to take the RMD, they still have to do the -1 in looking at their next year's distribution. Okay, so an affected person. So the question is, even though my RMD is waived, if I take a voluntary distribution, can I spread the taxes over 3 years? Can I roll it back in 3 years? Am I an affected person? So what's important here is we don't want to confuse the rules. So these coronavirus related distributions, or CRDs, we don't want to confuse those with the RMD waiver. There's two separate and distinct rules or guidelines. So if you are an affected person and your voluntary withdrawal is a legitimate CRD, then we want to follow those CRD rules. Otherwise, you're going to follow the RMD waiver guidelines as applicable. Okay, so just kind of wrapping up here, we talked about the plan loans. We talked about the ability to make the IRA contributions up till July 15th. And we spent most of our time talking about the waivers. We also talked about the coronavirus related distributions. The point that I just kind of want to wrap up with here is about changing IRA rules. IRAs they change and they cause confusion in normal times. In a case like this, you've got a law that just kind of popped out there because we have this pandemic, this crisis that happened. And so sometimes they're scrambling to get the law out, and then there's guidance that's required after, there's questions that come up. So the rules in a normal, they change. Again, we have the Secures Act that came out in December of 2019. Again, I'll be doing another webinar on that. We'll go into that in more detail. And there's certainly some important changes that I've made. But again, my point is, IRA rules change and they certainly cause confusion. That can certainly lead to unnecessary and excessive taxation for mistakes. So you really, really want to be careful with these things and make sure you know what you're doing before you do it. Some of those mistakes are fixable and some are not, right? And so you just want to really be very careful. So to kind of a final point, you want to make sure you're working with an educated or qualified advisor who's an IRA specialist, because a lot of people don't know these rules. A lot of advisors are not familiar with these rules. A lot of CPAs and other tax professionals aren't always familiar with the rules. The IRA rules and the tax code that's related to IRAs is very complex, and it's really kind of more of a specialty area. So I've come across a lot of CPAs and estate attorneys, for example, that are not familiar with the IRA rules. They're great at doing most tax things and most estate planning things, but with the IRAs, not always the case. right? So you just want to make sure that you're getting the right advice and you're not running into one of those mistakes, certainly the ones that can't be fixed. When I go to these Ed Slot workshops, I mean, every single time there are new court cases, tax court cases where somebody made a mistake, they're trying to fix it, and they're paying all kinds of money in filing fees and court fees and professional fees to try to get to fix things, which oftentimes could have easily been avoided if they knew the rules ahead of time. So if anybody has any questions, please feel free to reach out to me. If you need to schedule a call, you see the link on the page there for my booking system, and so you can book a call there. So that is it. I appreciate everybody jumping on and listening to this not so exciting topic. A lot of these IRA rules and tax things are not really that exciting, but of course they are important. So I appreciate that you took the time out of your day to listen. And again, if you have any questions just schedule a call, send me an email. I'll try to reach out as best as I can to reply to those questions. And with that, we're going to turn this off here. And again, I thank you for your time.